Hey everyone, Douglas here, and welcome back to the MMT Macro Trade and this market recap. I am recording this on Sunday, November 20th, 2022. But what we're going to be talking about is how this week finished on Friday with a big drop that we saw in oil. I've got the chart obviously pulled up right now on the screen, and we'll get to this in just a second. Quick summary though of the week. All in all, a pretty simple kind of consolidation week in the markets. No real big swing. Obviously, the week prior we had the inflation data come out that really sent the markets surging. But while the week in the equity space was pretty quiet, oil finished off with at least quite the bang, quite the drop, really, and is a bit surprising given where the data is at. So we're going to look at, like I said, we're going to take a look at oil. We'll take a look at the chart, go over kind of the Elliott count and a possible target. We'll also go over the implications and kind of the knock-on effects of the drop in oil. Also explain why it's a bit surprising and what the implications are going to be going forward to the broader market and stocks in particular. I think the implications here could be quite bullish, assuming normally when we see a big drop in oil, it has some bearish implications. Assuming those are not the reason for the drop, then maybe the knock-on effects here could actually end up being quite bullish for the equity space. So I will kind of explain that as we go along. Before we get into the nitty-gritty though, if you are not yet subscribed, make sure you hit that subscribe button, turn the notification bell on as well. And if you find this video particularly helpful, make sure you give it a thumbs up on the way out. All right. Taking a look at oil, and what I'm going to do real quick is show you my prior chart, which the overall idea here is that I had a consolidation triangle that I thought was going to be underway, and I really was relying on my main model. It's a supply side model for oil that I was anticipating maybe a longer term consolidation of the price of oil, but overall for the price of oil to hold on, consolidate sideways for a while, and maybe eventually push higher. Again, that's what the data seemed to indicate was the likely path forward. Obviously, that didn't happen and pretty much invalidates this idea as a whole. And so I've updated the overall idea in oil now. We could still technically have a wave 4 underway from the lows back in April of 2020 with primary wave 1. I'm going off the red count here. Primary wave 1 from the initial surge higher. Primary wave 2, the couple month pullback there into the end of 2020. Primary wave 3 being the play out into the Russian invasion of Ukraine and the spike that happened in February and March at that juncture, and then this being a primary wave 4 as long as it stays above the late August 2020 highs. This would still be a valid wave 4. In terms of the count, we'd be looking at a 1-to-1,618 ratio for that target, so bringing us right around $66 for an idealized target here from a Fibonacci standpoint. So for the count, that idea that I've had for quite some time now still remains quite valid, but I think there's also a very reasonable chance here that we get a extended consolidation. Obviously, I don't think we're going to get all the way down to, say, 42, 43 to invalidate this count, but a very reasonable idea here is that we're going to carve out some sort of longer-term kind of sideways, slightly lower price in oil here that ends up being some sort of B wave, X wave for WXY pattern. Some of it remains to be seen, but we have some sort of sideways action here that remains in consolidation for a while before we then eventually emerge higher from that. Either way, in terms of the actual, where I'm seeing oil land at this point from a purely technical standpoint at this juncture, I do think this support right around $63 makes a lot of sense. That would be kind of a long-term support zone. I also think the 50% retrace back down to 70 makes a lot of sense as well. So at least for the short run, kind of given the technical tools that I'd like to rely on, that is where I'd be seeing the price of oil to likely land, where we would see some support show up. So somewhere right around this region. And then, likely just kind of move sideways for a while, like I said, build some sort of bottom before eventually the next push higher emerges. I do think you can make a pretty strong case that eventually there will be kind of the next push higher, but for the time being, clearly, we're seeing oil give way here. So with that being said, given the big drop that we saw on Friday, this can have usually when we see swift drops, it can have a bit of a bearish connotation, right? We've seen these moves happen historically, right? We'll take a look back at 2018 into through late 2018. A better example, 2014 through 2015. where we see these sell-offs in oil that also are corresponding with a relatively strong dollar, rise in dollar, and otherwise kind of tight financial conditions overall in the market. And so the kind of theory is why oil sells off, and one of the implications of oil selling off is that maybe there is a rise in the need for central banks, especially oil-rich central banks, to go ahead and sell oil to go ahead and raise dollars for their domestic banking systems. And we can essentially check to see if this is what's happening by just looking at the dollar. And that was really one of the surprising things on oil's slide, is obviously the dollar after the CPI data continues to push lower, but we haven't really seen a massive recouping yet by any stretch of that drop from about a week and a half ago, and overall from the high back at the end of September. It's pretty much resolved itself. The only thing we can do, too, is see if there's any sudden swap activity on the central bank. Is the Fed helping out other central banks? And although we had the big push at the end of October, that has leveled out. Maybe by next week it'll show up in the data that there were some swaps. But at this point, we're just not seeing it. We didn't see the dollar index spike higher. I really just think what is likely happening then with oil is that we're seeing this drop in oil because effectively probably the Saudis are just agreeing with the U.S. policy right now that they want to that they're going to continue to produce, push their excess capacity, keep the price of oil level, and maybe there's some sort of agreement there between the U.S. and the Saudis to allow this to happen to help inflation for the time being. But that seems to be what it is, because at least from the data that I follow right now, I'm not seeing at this point that supply is picking back up. I'm going to go ahead and bring up my comparative inventory model here. I will bring up the data dashboard, and you can continue to see comparative inventory, which is just a relative inventory track, right? It takes the 5-year average of what inventory is at Cushing and takes the current inventory and divides those out to get the comparative inventory, or subtracts those out to get the comparative inventory. So it's a relative supply inventory. Obviously, this tracks very closely, as you can see, inverse the price of oil, and we've continued to see comparative inventory push lower as oil has really the price of oil has really given way, going all the way back to June, and continues to push lower itself. So there's a bit of a contradiction in the data right now, but a divergence from the data. And that is why I've been moderately bullish, although I haven't had a position long oil. I've thought that oil will likely continue to push higher, given the comparative inventory and its kind of predictive power to see oil prices push higher. So what explains this again? I mean, I just think that obviously someone somewhere has excess capacity to continue to supply oil. We're not seeing a shortage of the supply side at this point push price higher. The other implication, too, especially of the comparative inventory model, is, well, as it is kind of in this new generation that we're in, where the U.S. is now a net exporter of oil, and we're bringing a lot of financial assets from that side. Maybe there's going to be a bit of a reset in terms of how this model tracks, but as it stands right now, we are seeing, like I said, a bit of a contradiction between the price of oil, and actually comparative inventory. And again, maybe as kind of the cycle resets and we have this new reality of the U.S. being the net exporter that it is, that it has some time to recalibrate, and we see maybe a new trend eventually emerge where the negative correlation picks back up. But as it stands right now, we're not seeing that. So effectively, the story goes, oil drops that can have negative connotations for the markets. What do we want to look at? Well, we want to look at a relatively strong dollar, at least in recent history in the past week or two. We haven't seen that. Exactly the opposite. We're seeing the dollar finally give way. We're not seeing anything in the banking data that's showing sudden stress. We're just seeing oil push lower. And at this point, I think, given the fact that we're not seeing stress at this point in the financial system, we can start to say, okay, maybe we are just going to start to see a little bit of extra supply here relative to the demand, and that this could have, like I said, an actual positive or bullish impact to the larger equity space. I'm going to switch back as I kind of make this case back to the oil chart here. So here's kind of what I'm thinking, right? Is if we can get down to that like 65 range in oil, maybe even lower, the implications of this on the equity space are going to be quite large. One, it's going to lower inflation. The energy costs, the energy pass through on inflation will start to go down. The implication of inflation going down is then twofold. One, that's going to help push rates lower. I can show you the correlation between interest rates and oil. There's been obviously quite the disconnect going back to about August of rates and oil. If this helps push rates lower in the interim, that will stop the kind of cycle of rates pushing inflation higher in and of itself. Hopefully that can bring the inflation down. And then the other thing too, if it can bring inflation down, it will also remove some of the inflation pressure that's coming from the fiscal support we have relatively strong and have had actually recently very strong fiscal support. Those fiscal flows, which become the income flows of the private sector, has been building quite a lot over the last few months. I think we can start to see those get even more potent as inflation comes down and some of the inflationary effects that have happened from the fiscal flows kind of being taken away, the potency being taken away from the private sector can hopefully begin to give way. And so if inflation comes down, rates come down, and the fiscal flows remain strong, that sounds like a really strong bullish case going forward. And I really think that's kind of where we're at. Again, it sets up a bullish case if the underlying implication of the oil drop isn't a sudden kind of dollar squeeze, if you will. The other thing to think about too is, given the surge in rates, there's a rebalancing effect that happens on a lot of portfolio constructions where there will be a preference towards the higher yielding, safe bonds, and if rates come down, that can shift those sort of portfolio rebalancing back to a more neutral posture. Meaning the new flows that are going to be coming in, that are going to be invested, we'll start to see the now kind of devalued equity space is more and more appealing if rates can come down as well. And again, I think oil could help push that lower. So a lot of potential implications here given the drop in oil, and definitely just kind of, again, if this isn't kind of the bearish drop where central banks are needing to raise money, then and it's just a repricing lower to kind of a better market price of oil, then the implications, I think, become quite bullish for the equity space. We'll have to see how it plays out, obviously, and we're going to need to continue to see fiscal flows remain strong. We'll really want to see the bank flow, the credit expansion cycle start to kick up again. We're still having a lot of issues there, but this is just another sign that we might be in for a bit of a bullish rally as we head into the end of the year, and then possibly even into next year. Anyway, that's what I have today for oil, and I think I will wrap things up here. But before you go, if you are an active trader, active investor, you like this sort of MMT-based analysis on markets and you find it helpful, check me out over at my Patreon page over at patreon.com/MMT Macro Trader. I'm still offering the November promo here for access to the premium access, multiple updates each week. Just a ton of data over there that correlates very strong with equity markets, and I think is a great tool and some great data for active investors and active traders. Anyway, I will wrap things up right here. So until next time, good trading, everyone, and we will talk to you then. Bye-bye.